Welcome to the Steady Hand webcast. I'm Tom Bradley, President of Steady Hand Investment Funds. I have with me today Joe Sertivan, who with his team at Glibier Capital Management is the new manager of our small cap equity fund. Welcome, Joe.
Good to see you, Tom.
Now, given that you're relatively new to the fund, we thought it was important to bring a little color, put a little color on the fund and what you're holding and where your focus is. So maybe we can just start with the changes you're making in the fund since the previous manager was pretty distinctive, 15 to 17 holdings, very much look different than the index, our indexing philosophy. How will it look under your stewardship?
Well, we also favor a very concentrated approach to investing, although we may broaden out the number of names from the 17 or 18 that are in the fund right now to a little bit over 20, but never more than 25. In terms of exposure geographically, we're probably going to look to add a little bit to some U.S. exposure as opportunities present themselves. I believe we can go up to about 30% of the fund in U.S. names, so that's an area that we'll probably see some inclusion. And finally, in terms of the type of companies held, as you know, we favor steady earnings and cash flow growth stories, so we tend to limit our exposure to more cyclical industries such as base metals, paper and forest, the cyclical sectors in the market.
Now, indexing, one of the tenets of indexing is that we don't constrain our managers, and indeed in the past we've owned some mid-cap and even a large cap stock. Where's your focus as far as the size of companies goes?
Right, so again, we're looking at the smaller end of companies because we find more inefficiency in pricing and better growth prospects in smaller companies. So in Canada, probably the largest company in market capitalization we'd look to own is about $4 billion. More likely our sweet spot will be $3 billion or less. And in the US, I think $10 billion is probably the absolute maximum we'd be looking to have companies with respect to market cap. And again, we own, certainly we look to own companies as small as $1 billion or so in market cap in the US.
Now, Cargojet is a prime holding in the fund now. Maybe you can tell us the thesis behind that and try and give us some insight as to what you think the market's missing on this one.
Yeah, Cargojet is a provider of air haulage services for cargo, and its principal customers are Purolator, some of the other U.S. courier companies, and most recently Amazon. And the company has a very interesting fleet of aircraft and has significant utilization right now that make the economics of the model very strong. But there is excess capacity, and they recently signed a deal with Air Canada to start doing some cargo haulage for Air Canada, which we think will be a very significant driver of future earnings growth. So we don't know if investors have factored that into the Cargojet valuation. We see the stock having very significant upside. We think $45 is fair value for the stock right now, and I think it's around the mid-30s. And actually, we bought it at 12, so it's been a great name for us.
Now, another one's a bit of a mouthful for me anyway, Echo Global Logistics. What about that one?
Yeah, well, we're staying in the freight space. This is a U.S.-based, less than truckload freight forwarding company, and that's a very technical term to say that basically they match up desires of freight services. So a company wants to ship something somewhere, they phone up Echo Global Logistics and say, find me a truck or find me a piece of a rail car, get me some exposure to your fleet or your virtual fleet of freight services. And so they just act as a broker. This is a very fragmented industry in the United States, but their secular opportunity is very large. And by secular, I mean steady. The steady growth in this industry is happening because there's a significant move by U.S. companies to outsource their freight services to companies such as Echo Global Logistics. There's also a lot of regulatory factors that are driving demand for their services. The company has recently made an acquisition into a complementary business that allows it to be much more of a turnkey solution for its clients. So we think its secular growth prospects are very, very strong.
Now, changing gears a little bit, another one that will factor largely in the fund is Enghouse.
Right, Enghouse, which is a consolidator of software services companies globally. And it trades alongside its larger peer in Canada, which is Constellation Software. What makes Enghouse a little bit different than Constellation is that management team at Enghouse seeks to really optimize the operations of the companies that it acquires as opposed to operating them sort of on a standalone basis, which is more the Constellation model. So there is margin enhancement going on within Enghouse, and we think that investors aren't necessarily seeing that. We like the management very much. We think the past record of acquisitions, the discipline they bring to bear, has very good potential for future accretive acquisitions, and so the story looks very intact to us. Market cap's about $1.5 billion, so again, any acquisition can be quite material to the valuation of the company.
And Joe, we've talked about some very different businesses, but you got to piece them into a coherent portfolio. How do you ensure that the portfolio, and indeed our fund, is properly diversified?
Well, Tom, our most important method of risk control isn't diversification. It's business selection based on those 5 criteria and price paid. So we are truly a growth at a reasoned price manager, and so we manage risk that way. However, no one name will be greater than 10% of the portfolio, and no one industry will be greater than 30% of the portfolio.
So talking about industries, is there some industries, sectors of the market you particularly like right now?
Well, at Galibier, we really don't spend a lot of time thinking about sectors. We think about companies, and we think about whether or not they meet our criteria with respect to those 5 factors, most important being an enduring and sustainable competitive advantage. So that's our favorite sector, companies that have enduring and sustainable competitive advantages, which means that we tend to underweight cyclicals, as mentioned earlier, in the portfolio because they just don't offer those enduring competitive advantages.
Now, we talk a lot about buying stocks. That's the exciting part of our business, as you know, but maybe the tough part is selling. So maybe you can give us some sense of what prompts you to sell a stock, and you're new to our fund, but maybe an example of something you sold out of a Galibier portfolio previously.
Well, the happiest reason to sell a stock is because the price is appreciated way above our view of intrinsic value. So those are always happy days, and often we have to sell a stock to buy a better idea. When we think of the portfolio, we think of a rowing scull. And we think of all the positions of the portfolio kind of like being oars in the water. And we want to make sure that every oar in the water has significant upside. So that's one way we think about our portfolio. The other reason we might sell a stock is that, unfortunately, sometimes we make a mistake and the criteria hasn't evolved the way we hoped it would. So a company can lose its enduring and sustainable competitive advantage. It can lose the quality of its management. Things like that can happen. A name that comes to mind that we sold a while ago was Teradata in the United States, which is a provider of big data services and big data analytics, and was a dominant player in its marketplace until Amazon Web Services entered that marketplace with a very aggressive pricing strategy. And you never want to be in competition with Amazon. So we said goodbye to Teradata, unfortunately. We made a little bit of money on it, though.
Joe, this has been great. I thought it's added some nice color to the portfolio, and our clients are new to you, you're new to them, so just a great start. Thank you.
Looking forward to starting. Thanks.
And thank you for watching.